The rise in IOF, the spike in energy bills, and inflation squeezing the cost of living, these factors have been keeping many investors awake at night, especially those who live, or want to live, off passive income. If you have real estate, funds in your portfolio, you might be asking yourself, are dividends going to drop? Should I sell now or buy more? The truth is, in uncertain times like these, the worst decision is indecision. In this video, you'll understand how these increases truly affect FII income distribution, which sectors are most vulnerable, and how to protect your income with strategy, not panic. Before making any decisions, it's important to understand what's going on. The IOF, or tax on financial transactions, has been raised for certain operations, making credit more expensive for businesses and consumers. This puts pressure on the entire economy, especially the productive sector. At the same time, electricity prices keep rising, driven by rate adjustments and production costs. These two factors increase fixed costs for companies and properties, which directly affects the operation of logistics warehouses, shopping centers, malls, and office buildings. And when costs rise, tenants either pass them on to consumers or tighten their budgets, which in some cases impacts their ability to pay rent or renew contracts under the same terms. The result? Pressure on fund revenue and a real risk of reduced dividends. But not all funds react the same way in this environment. Mall funds, for example, are highly dependent on consumer activity. With higher energy costs and IOF, retail suffers, traffic drops, and the fund's performance follows. Corporate office funds tend to struggle more in big cities, where fixed costs weigh heavily and vacancies are still an issue. Logistics funds tend to hold up better, especially those with long-term contracts and automatic adjustment clauses. And paper funds, which invest in CRIs and other credit instruments, can actually benefit in this scenario, especially those indexed to inflation, IPCA, or interest rates, CDI, as higher inflation and rates increase returns on these assets. Knowing how to identify these trends is what separates those who protect their capital from those who lose returns due to lack of vision. Now let's talk about the most sensitive topic, dividends. Will they go down? The answer is, it depends. Funds exposed to sectors with thin margins or short-term contracts face a higher risk of cutting distributions. On the other hand, funds with well-located assets, reliable tenants, and contracts tied to inflation indexes tend to maintain or even increase payouts over the medium term, especially paper funds with CRIs indexed to IPCA or CDI, which receive automatically adjusted payments. One key point, even with market volatility, many FIIs continue paying 0.8%, 0.9%, or even more per month, outperforming most conservative investments. The key here isn't just looking at current yield, but understanding the source and sustainability of that yield. So how can you protect your portfolio and your income in this scenario? The first step is to review your exposure. Are you too concentrated in malls or office funds? Evaluate the tenant's financial health, contract maturity, and vacancy levels. Then diversify. Add paper funds with strong governance, solid collateral, and reliable indexation to IPCA or CDI. These funds are usually more stable during turbulent times. Also, maintain a reserve in fixed income with daily liquidity, such as Treasury Selic or high-quality bank CDBs. This reserve acts as a cushion against volatility and gives you flexibility to seize new opportunities calmly, and most importantly, avoid reshuffling your portfolio out of emotion. Selling a solid fund just because its price dropped 5%, even though it's still paying consistent dividends, can be a costly mistake. A common question at this stage is it worth investing now? Or should I wait? The idea of waiting for the perfect moment usually causes more harm than good. When the outlook seems worst, prices are often more attractive, and dividend yields go up. That means you can build your position with greater return potential. Of course, this doesn't mean going all in at once. A smarter strategy is to invest in tranches or staggered entries, reducing risk over time. This way, you get exposure. With intelligence, take advantage of good opportunities and protect yourself from deeper corrections. Remember, the focus in FIIs is recurring cash flow, not the share price tomorrow. To make this even clearer, here's a quick checklist to help you act with confidence now. Review your portfolio and identify which funds are most exposed to cost. Pass-through risk. Maintain or increase your position in paper funds with strong indexation like IPCA and CDI. Ensure a strategic cash reserve in daily liquidity fixed income. If you plan to invest, do it gradually to smooth out volatility. Don't make decisions based on panic or headlines. Use data, consistency, and long-term thinking. The message is simple. You don't need to time the market perfectly. You need to act with strategy and balance. In times of noise and uncertainty, the best results come to those who stay focused on what matters most: stable cash flow, quality assets, and well-grounded decisions. If this video helped you better understand the current scenario and think more, clearly leave a like, subscribe to the channel, and comment below. Are you planning to hold, sell, or buy more FIIs right now? Here, we talk about passive income with realism, without panic, and with a focus on what really matters: building long-term stability with intelligence. See you in the next video.